Mic check.
Money check. Mindset check.
This is Mic'd Up Money Reloaded.
Where entrepreneurs talk money,
Strategy, systems,
and execution. No fake hustle, no empty flexing, just real business talk that gets you right.
Mic'd Up Money
Reloaded, talk that strategy, show it. Systems moving, profit growing. Real entrepreneurs already know it. No fake value, better own it. Price meets pain when the bridge is built. Execution turns the vision golden. If the plan is weak, the pressure gets felt.
Mic check.
Money check.
Mindset check.
This ain't just motivation. This is business correction. This ain't just conversation. This is money direction.
You want profit, build the model. You want growth, fix the flow. You want increase, check the numbers.
What you don't know can stop the show.
Mic'd Up Money
Reloaded, talk that strategy, show it.
Systems moving, profit growing.
Real entrepreneurs already know it. No fake hustle, no empty flexing, no more guessing, no more
Stressing, money, strategy, systems,
execution.
reload the vision, rebuild the plan.
Price the value, know where you stand.
Mic'd Up Money
Reloaded.
bumping 96.3 FM. iHeartRadio, YouTube.
Where entrepreneurs talk money,
Strategy, systems.
and execution.
Stop just listening.
Start applying.
Mic'd Up Money,
Reloaded.
let's get it. Let's get it.
Disclaimer. The information shared during this program is for educational, informational, and general business development purposes and should not be considered individualized legal, tax, accounting, employment, financial, or human resource advice. Every business, customer relationship, employee situation, contract, compensation arrangement, and ownership structure is different. When making significant employment, legal, financial, or contractual decisions, consult the appropriate qualified professional. Now let's talk about the money. Introduction. Welcome to Mic'd Up Money Reloaded. I'm Efrem Simmons, Senior Business Consultant, Business Strategist, and Senior Training and Development Professional. Today we're talking about something businesses discuss constantly, but usually too softly: customer service. Most businesses think customer service means smile, be polite, answer the phone, say thank you, and treat people well. All important. But customer service is bigger than courtesy. Customer service is an economic activity. Poor customer service can cost transactions, repeat business, renewals, referrals, contracts, reviews, reputation, customer lifetime value, profit, and in a small business where revenue can move by hundreds of thousands of dollars, it can threaten survival. So today's episode is when bad customer service is costing you bank. Because sometimes your competition isn't stealing your customers, you're giving them away. And sometimes the person helping drive them away is an employee, a manager, the owner, a family member, or somebody the owner is afraid to replace. Because at least I have somebody, I can't do all this alone. Today, we're going beyond customer complaints. We're going to look at the economics, the warning indicators, the training needs, the systems, the incentives, the staffing realities, and the management decisions behind the customer experience. Let's get into it. Segment 1. Bad customer service is a revenue leak. When a customer complains, too many owners hear. One person is unhappy. You need to hear. A revenue relationship may be at risk. Suppose someone spends $100. An employee may see a $100 transaction, but what if that customer spends $100 twice a month? That's $2,400 annually. What if they stay 5 years? That's $12,000. What if they refer family, coworkers, clients, and friends? Now, the economic value of that relationship is much larger. That's why the question isn't only, how much did they spend today? The better question is, what is this relationship worth if we keep it? Bad service creates a chain. Bad experience, reduced trust, reduced spending, fewer repeat purchases, fewer referrals, customer leaves, and then the company spends money trying to replace them. So the business gets hit twice, lost revenue plus replacement cost. Customer service belongs in the financial conversation because customer loss eventually becomes revenue loss. Segment 2. Customers may forgive the product before they forgive the service. Restaurants make this easy to understand. Customers know food can occasionally be wrong. The steak gets overcooked. The fries come out cold. The kitchen gets backed up. Somebody enters the wrong order. If the restaurant handles it well, many customers will say, everybody has a bad night. But let nobody acknowledge them. Let the server act irritated. Let somebody roll their eyes. Let the manager become argumentative. Now the customer feels something different. Bad food can feel accidental. Bad service can feel personal. The customer may forgive the burned burger. They have a harder time forgiving being treated as though their money doesn't matter. Bad product disappoints me. Bad service disrespects me. And disrespect changes where I spend my money. When the food is wrong, I question the meal. When the service is wrong, I question the business. And customers buy the whole experience. The product, the greeting, the wait, the communication, the checkout, the recovery, the convenience, and the respect. Segment 3. The customer friction tax. Every unnecessary obstacle creates what I call the customer friction tax. The customer pays in time, confusion, inconvenience, uncertainty, frustration, repetition, and emotional energy. They call, nobody answers. They leave a message, nobody returns it. Friction tax. They explain the issue to 3 different employees. Friction tax. Your website says one thing and your employee says another. Friction tax. They can't schedule, can't get a clear price, can't figure out who owns the problem, or can't resolve something simple. Friction tax. Eventually, doing business with you becomes more difficult than the customer believes you're worth. And then they find your competitor. Your competitor doesn't always have to be dramatically better. Sometimes they just have to be easier. Easier to reach, easier to buy from, easier to understand, easier to resolve problems with. Convenience has value, clarity has value, responsiveness has value, and difficulty has a price. Segment 4. The customer who never complains. One of the most dangerous customers may be the one who never complains. Businesses say, we don't get many complaints. That does not automatically mean customers are satisfied. Sometimes they simply don't believe you're worth the argument. One customer complains loudly. The owner calls them difficult. 10 others experience the same thing and quietly stop coming. Who gave you more useful information? The complainer. At least they gave you a warning. The silent customers simply disappear. Their future purchases disappear. Their referrals disappear. Their value disappears. And later the owner sees revenue down. But the financial statement doesn't say, customers left because the manager was rude. It doesn't say, this account disappeared because nobody returned calls. It simply shows less revenue. Their absence becomes the invoice. Segment 5. When leadership is the customer service problem. Bad service from an employee is dangerous. Bad service from the manager or owner can be worse. If the employee is rude, the customer may think, maybe I got the wrong employee. They ask for the manager. But what happens when the manager is the problem? Maybe they ask for the owner. What happens when the owner is worse? Now there is no appeal. The customer stops thinking, that person had a bad attitude. They start thinking, this is how this company operates. Leadership behavior also trains employees. If the owner interrupts customers, employees notice. If management dismisses complaints, employees notice. If leaders talk about customers like nuisances, employees notice. You cannot tell people customer service matters while leadership demonstrates the opposite. Sometimes frontline employees do not need the training. The boss does. Your title does not protect you from being the reason customers leave. They may not be loyal. They may simply be tolerating you. Tolerance is not loyalty. Segment 6. When customer service becomes a 6-figure problem. Now let's put money around this. Suppose your business generates $1 million. Revenue declines 10%. That's $100,000. Somebody says, well, you still did $900,000. That's revenue, not profit. Your rent didn't automatically fall 10%. Insurance didn't fall 10%. Debt payments didn't fall 10%. Many fixed expenses remain. So a $100,000 revenue loss can create a much larger impact on profit. This becomes especially dangerous when the business has a small number of major customers. A consultant may have 10 significant accounts. A contractor may have 4 major commercial clients. A supplier may depend heavily on 2 purchasers. Lose 100,000 relationship because of bad service and your entire year can change. Customer service can become strategic risk. Segment 7. How does the owner detect the problem? Don't wait until year-end financial statements tell you something went wrong. Build a customer service revenue leakage monitor. Repeat customer revenue. How much of your revenue comes from returning customers? If new sales are increasing while repeat customer revenue is falling, marketing may be hiding a retention problem. Customer retention. How many customers who should still be doing business with you actually are? Purchase frequency. A customer bought 4 times a month, then 3, then 2, then once, then disappeared. They may be communicating dissatisfaction with their wallet. Revenue churn. Don't only count customers lost, count the dollars that left with them. Revenue at risk. If 3 major customers are complaining, don't just report 3 complaints. Ask how much annual revenue those relationships represent. If the answer is 110,000, that's the number leadership should see. New customer revenue versus lost customer revenue. Your company brings in $180,000 of new business, but loses $230,000 from existing customers. You're not growing, you're moving backward by $50,000. Customer replacement burden. If you lose $150,000 of customer revenue, the first $150,000 of new sales merely gets you back to zero. That isn't growth, that's replacement. Segment 8. A metric without a management response is just a number. Here's the part most dashboards miss. Finding a warning indicator is not enough. If repeat customer revenue drops, a major account complains twice, purchase frequency materially declines, or a significant customer asks for another representative, what happens next? Who investigates? How quickly? Who speaks with the customer? Who reviews the employee or manager involved? Who decides whether this is a training, system, staffing, pricing, or leadership problem? A metric without a management response is just another number on a report. Every customer service dashboard should have response triggers. Green means the pattern looks normal. Yellow means investigate. Red means leadership intervention. The exact thresholds will differ by business, but the principle should not. Somebody has to be responsible for turning the signal into action. Segment 9. When growth breaks customer service. Sometimes bad customer service does not begin because the business is failing. Sometimes it begins because the business is growing. Sales rise faster than staffing. Appointments rise faster than scheduling capacity. Customers rise faster than inventory. Orders rise faster than production. Calls rise faster than the team can answer them. The owner celebrates the revenue and misses the strain. Now the business is technically growing, but the customer experience is deteriorating. That creates a dangerous pattern. Growth produces delays. Delays produce frustration. Frustration produces complaints. Complaints produce employee stress. Stress produces more mistakes. Then customers begin leaving. Sometimes the business grew faster than its systems. But if you don't fix it, growth can become the thing that starts the decline. The solution is not to stop growing. The solution is to build operational capacity before demand outruns the experience. Segment 10. The customer service death spiral. Here's what can happen next. Customers leave. Revenue declines. The owner cuts expenses. Staffing gets reduced. Now fewer people are serving customers. Wait times increase. Employees become overwhelmed. Errors increase. Service gets worse. More customers leave. Revenue falls again. Then the owner says business is slow. Maybe, or maybe customers are leaving. Those require different solutions. And here's the mistake. The owner responds by buying more advertising. Now you're paying money to bring new customers into the same broken experience. That's like filling a bucket with a hole in the bottom by buying a bigger hose. Fix the hole. Segment 11. Training problem, incentive problem, or performance problem. This is where training and development matters. Not every customer service failure comes from a bad attitude. Before you train, discipline, or terminate someone, diagnose the cause. Knowledge. Do they understand the product, policy, pricing, refunds, scheduling, and procedures? If not, train them. Skill. Can they listen, communicate, de-escalate, explain policy, handle difficult conversations, and solve problems? If not, train and coach them. Judgment. Can the manager determine when to escalate, when to make an exception, when to refund, and when to protect the relationship? Judgment needs scenarios and coaching. Authority. Do employees know what to do but lack authority to do it? Then training alone will not fix the problem. Systems. Is the real problem understaffing, broken software, bad scheduling, inaccurate information, or poor processes? You cannot train employees to overcome every broken system. Management. Can the manager coach, resolve conflict, hold people accountable, handle escalations, and communicate? Maybe the development need is above the frontline level. Incentives. What behavior are you paying people to produce? If you reward only speed, employees may rush customers. If you reward only new sales, people may overpromise and leave service problems behind. If a manager's bonus depends only on cutting labor, understaffing may become financially rational to the manager even while it destroys the experience. Before blaming the employee, check the incentive. People often optimize what the business measures and rewards, even when it damages something the business forgot to measure. Skill versus will. Can they do it? That's skill. Will they do it? That's will. If the person lacks skill, develop them. If the person knows what to do and repeatedly refuses to do it, that's a performance issue. Training is not a substitute for accountability. Segment 12. At least I have somebody. Now we get into the small business reality. The owner knows the manager is weak. Customers complain. The owner sees it, but they say, at least I have somebody, because the other option feels like I'll have nobody. And the owner is already doing sales, payroll, marketing, purchasing, scheduling, operations, bookkeeping, and customer service. They say, I can't do all this alone. And that may be absolutely true, but sometimes the wrong person creates more work than an empty position. They create complaints, refunds, rework, customer recovery, employee conflict, and lost revenue, and then the owner still has to come behind them and clean it up. So now you're paying somebody and still doing part of their job. That's not leverage, that's expensive dependency. Segment 13, the single point of failure employee. Small businesses often become dangerously dependent on one person. That employee knows every password, every customer, every vendor, every process, and every shortcut. And the owner says, I can't afford to lose them, maybe, but also ask, can I afford to keep them? If one person leaving can cripple your operation, you have a business continuity problem. The answer to, I can't do this alone, should be cross-training, documented procedures, backup staffing, technology, contract support, recruiting, and systems. Not permanent dependence on one employee. Temporary necessity may be real. Permanent dependency is dangerous. Segment 14, when the manager is family. Now make the situation even harder. What if the manager is your son, daughter, brother, sister, spouse, cousin, niece, or nephew? Now you're not just thinking, should this person keep the job? You're thinking, what happens to the family if I remove them? That's real. But family status cannot create permanent immunity from business standards. Customers don't care that the manager is your brother. They care how the company treats them. Family is a relationship. Manager is a role. You are not firing your brother from being your brother. You are deciding whether your brother should continue managing the company. And here's the test. Would I tolerate this performance from a non-family manager? If the answer is no, family may be distorting the decision, but don't jump immediately to termination. Maybe the family member needs training, coaching, reassignment, reduced customer contact, demotion, a different role, structured improvement, or transition. Some people are excellent technicians and terrible managers. Stop treating management like a lifetime achievement award. A title should serve the business. The business should not exist to preserve somebody's title. And if you genuinely cannot remove them today, don't confuse I can't remove them today with I can never remove them. Build the transition. Segment 15, when the person driving customers away wants a raise. Now we get to another uncomfortable contradiction. Customers are leaving, complaints are increasing, revenue is declining, and the person involved says, I deserve a raise. Based on what? Employees deserve fair compensation. Strong employees should be rewarded. Good managers should have opportunities to earn more. But compensation should connect to value creation, value protection, responsibility, performance, and results. If you're strengthening customer relationships, protecting revenue, leading employees, improving service, and increasing performance, let's discuss increased compensation. But if multiple customers do not want to deal with you, complaints repeatedly involve you, and accounts are disappearing, we need to discuss performance first. And here's the financial question. What do they cost to employ versus what do they cost to keep? A manager may earn $70,000. That's what they cost to employ. But if their behavior contributes to losing $100,000 of customers, salary isn't the full cost. Customer destruction is the hidden cost. Segment 16, consultants. Access does not mean unlimited free labor. Consultants and professional service providers face a different customer service problem. Sometimes they give too much away. The client pays an access retainer. Then over time, they begin believing access means everything is included. No, there is a difference between can I call you and can I assign you another project? There is a difference between can I ask a quick question and can you review 40 pages and prepare a strategy? Consultants often create this problem themselves. Answer late at night, free. Review extra work, free. Spend another hour solving a new issue, free. You think I'm giving great service, but you're also teaching the client that the additional value has a reference price of 0. Then, when you eventually charge, the customer thinks something was taken away. Good customer service is not unlimited availability. Good customer service is clarity. Define what's included. Response standards included time, communication channels, what becomes project work, and what requires additional fees. Access does not mean ownership of the consultant's time. If access has value, access needs boundary. Segment 17. Not every customer is equally profitable. Now let's add another financial distinction. Revenue and customer value are not always the same thing. A $50,000 client may sound important, but what if that client consumes enormous amounts of unpaid support, requires constant rework, delays your team, creates repeated emergency demands, and generates very little margin? Meanwhile, a $25,000 client may pay on time, use the service as designed, refer other customers, and require very little recovery work. Which relationship is more valuable? Owners should look beyond customer revenue and examine customer contribution. Think about it this way. Customer revenue minus direct costs, minus service and recovery costs, minus excess support costs equals customer contribution. That does not mean you start firing every difficult customer. It means you stop confusing top-line revenue with healthy revenue. Some customers deserve recovery. Some deserve clearer boundaries. Some need repricing. Some need a different service model. And some relationships may no longer make economic sense. Customer service strategy should protect good customers, not trap the business inside unprofitable relationships. Segment 18, Behavioral Economics, why this gets worse than owners expect. Loss aversion. A painful service failure can outweigh several routine good interactions. Negativity bias. Serve someone correctly 9 times. Embarrass them once. Guess which story gets repeated. Peak end effect. Customers remember intense moments and how the experience ended. A mistake followed by great recovery may preserve the relationship. A mistake followed by an argument with the manager can make it worse. Reference points. If consultants repeatedly provide work for free, free becomes the customer's reference point. Scarcity and loss aversion for owners. Owners focus on what will I lose if this employee leaves, but often fail to calculate what am I losing because they stay. Customers, revenue, reputation, time, good employees, opportunity. Sometimes fear of losing one employee causes the business to lose 20 customers. Segment 19. Some customers are wrong and service recovery still matters. The customer is not always right. Some customers are unreasonable. Some are abusive. Some manipulate businesses. Some relationships need to end. Customer service does not mean customer submission. The objective isn't keep every customer at any cost. The objective is to stop losing good customers for preventable reasons. And when the company does make a mistake, recover intelligently. Listen, acknowledge, correct, explain, follow through. Sometimes recovery means a refund, replacement, credit, apology, or expedited service, but do the math. Don't argue for 30 minutes over $25 while risking a customer worth $5,000. What does recovery cost? What is the relationship worth? What does replacement cost? Now you're making a business decision. Segment 20. Somebody has to own the customer problem. One of the fastest ways to destroy a customer relationship is the handoff trap. That's accounting. That's sales. You'll have to call the manager. Send another email. That's not my department. Everybody touches the problem, but nobody owns the outcome. The customer should not have to understand your organizational chart to get their problem solved. Someone needs to own the issue from complaint to resolution. That does not mean one person performs every task. It means one person remains accountable for making sure the problem moves through the organization and gets closed. Assign ownership. Set a response time. Document the issue, escalate when necessary. Confirm the solution, close the loop with the customer. Otherwise, your internal handoffs become the customer's external frustration. Segment 21, Great customer service is not a system. Telling employees, give great customer service is not training. Define how quickly calls are returned, how customers are greeted, how complaints are handled, what authority employees have. When management gets involved, what can be refunded, what gets documented, and what happens when standards aren't met. Define what happens when warning indicators turn yellow or red. Define who owns a complaint all the way through resolution. Define what performance metrics matter, and make sure the incentives do not reward behavior that undermines the customer experience. If none of that is clear, you don't have a customer service system. You have a slogan. Systems do, training does, measurement does, leadership does. Segment 22, the customer service profit leak audit. Here's what every owner should examine. Customer retention, repeat customer revenue, purchase frequency, customer lifetime value, customer contribution, lost customer revenue, revenue at risk, new versus lost customer revenue, customer replacement burden, complaint patterns, response time, customer concentration, service recovery, management behavior, training gaps, incentive problems, system friction, complaint ownership, single point of failure employees. And then ask one question that should make you uncomfortable. If your best customer started leaving tomorrow, how many months would it take you to notice, and would you know why? Then ask the financial version. If my revenue declined $100,000 this year, could I determine how much came from customers who decided not to return? If the answer is no, you have a blind spot. Your accounting system tells you what happened. Your customer intelligence needs to tell you why. Toolkit segment, Customer Service Profit Leak Toolkit. The Customer Service Profit Leak Toolkit is designed to help owners move from vague complaints to measurable business action. It includes Customer Service Revenue Leakage Monitor, tracks retention, repeat revenue, purchase frequency, revenue churn, revenue at risk, new versus lost customer revenue, and replacement burden. Management Response Trigger Matrix establishes green, yellow, and red warning levels and assigns what management should do when indicators change. Customer Lifetime Value Calculator shows what a customer relationship may actually be worth. Customer Profitability and Contribution Analyzer moves beyond revenue and estimates the relationship's contribution after direct costs, recovery costs, and excess support. Lost Customer Revenue Calculator measures the dollars that disappeared with lost customers. Customer Friction Audit identifies unnecessary obstacles in the customer experience. Silent Customer Loss Tracker flags customers whose purchase behavior may indicate quiet abandonment. Customer Concentration Risk Assessment shows how dangerous losing one or several major accounts could be. Owner-Manager Customer Experience Blind Spot Audit determines whether leadership may be contributing to customer loss. Training and Development Needs Analyzer separates knowledge, skill, judgment, authority, systems, management, incentive, and will problems. Incentive Alignment Audit tests whether compensation and performance measures unintentionally encourage rushed service, understaffing, overpromising, or other harmful behaviors. Growth Capacity and Service Strain Check tests whether demand has outgrown staffing, scheduling, technology, production, or management capacity. Single Point of Failure Employee Assessment identifies dangerous dependency on one employee. Keep versus Replace Economic Analysis compares the cost of employing someone with the financial cost of keeping damaging behavior. Family Manager Decision and Transition Tool evaluates train, coach, reassign, demote, transition, or terminate options. Access Retainer Boundary Builder helps consultants define what access includes and what requires additional fees. Complaint Ownership and Resolution Tracker assigns one accountable owner from complaint through closure and confirms follow-up with the customer. Customer Experience Standards Builder turns give good service into measurable expectations. 30-day Customer Service Recovery Plan turns the audit findings into action. Because information without execution is entertainment, and we're not here just to be entertained. Strategic Hustling Moment. Don't count complaints. Count the money disappearing behind them. Ask, did we keep the relationship? Did we protect the revenue? Did we make it easy to buy? Did somebody own the problem through resolution? Did our incentives encourage the right behavior? Did growth outrun our capacity? Did we recover when something went wrong? Is the real issue training, systems, management, staffing, incentives, attitude, authority, or leadership? And most importantly, how many customers can this business afford to lose before customer service failure becomes a survival problem? Final thought. Everybody who stops doing business with you doesn't complain. They don't all leave reviews. They don't all demand refunds. Sometimes they simply leave, and they take their money, future purchases, referrals, and sometimes their entire account. Then 6 months later, leadership finally sees them, not standing at the counter, not calling the office, not sending an email. They show up as revenue down, margins down, cash tighter, and marketing costs up. And somebody asks, what happened? Don't wait until the financial statements tell you what customer behavior could have told you months earlier. Don't let "at least I have somebody" become permission for someone to damage your company. Don't protect a manager at the expense of customers. Don't let family guarantee somebody a management title forever. Don't confuse a training problem with a will problem. Don't confuse a system failure with an employee failure. Don't reward people for behavior that helps them hit a metric while damaging the customer relationship. Don't reward someone for helping the company earn less. Don't give away unlimited professional work and call it customer service. Don't confuse high customer revenue with high customer profitability. And don't spend thousands attracting new customers while your experience is driving existing customers away. Because they may not be loyal. They may simply be tolerating you. Tolerance has an expiration date. If this episode caused you to recognize customer service problems inside your business, do something with it. Go to mic'dupmoneyreloaded.com and get the Customer Service Profit Leak Toolkit. Use it to identify where customers may be disappearing, how much revenue may be at risk, whether the issue is training, management, incentives, systems, staffing, family business dynamics, customer profitability, growth strain, poor complaint ownership, or customer service behavior, and what needs to change before the financial consequences get worse. Because bad customer service doesn't always announce itself with an angry customer. Sometimes it announces itself months later with missing money. I am Efrem Simmons. This is Mic'd Up Money Reloaded, where entrepreneurs talk money, strategy, systems, and execution. And remember, you can't keep running customers away and then act surprised when the money runs away with them. Re-listen on the Mic'd Up Money Reloaded YouTube and podcast. Help us grow by subscribing on all social media platforms. Comment business education, and I'll see you next time.
Mic check.
Money check. Mindset check.
This is Mic'd Up Money Reloaded.
Where entrepreneurs talk money, strategy, systems, and execution. No fake hustle, no empty flexing, just real business talk that gets you right.
Mic'd Up Money
Reloaded, talk that strategy, show it. Systems moving, profit growing. Real entrepreneurs already know it. No fake value, better own it. Price meets pain when the bridge is built. Execution turns the vision golden. If the plan is weak, the pressure gets felt.
Mic check.
Money check.
Mindset check.
This ain't just motivation. This is business correction. This ain't just conversation. This is money direction.
You want profit, build the model. You want growth, fix the flow. You want increase, check the numbers.
What you don't know can stop the show.
Mic'd Up Money
Reloaded, talk that strategy, show it.
Systems moving, profit growing.
Real entrepreneurs already know it. No fake hustle, no empty flexing, no more guessing, no more
Stressing. Money, strategy, systems,
execution.
reload the vision, rebuild the plan. Price the value, know where you stand. Mic'd Up Money
Reloaded.
Bumping 96.3 FM. iHeartRadio, YouTube.
Where entrepreneurs talk money,
Strategy, systems.
and execution.
Stop just listening.
Start applying.
Mic'd Up Money,
Reloaded.
let's get it. Let's get it.